There is a number sitting somewhere inside your business right now that you have never calculated. It is not your revenue. You know that number. It is not your expenses. You track those too, more or less. It is the amount of money walking out of your business every single month through the easy hands of people you trust, people you pay, people who smile at you every morning, that you will never see again. Most African business owners assume this number is small. A negligible leakage, the cost of doing business with imperfect humans. The truth is almost always far worse than that assumption. Studies on small and medium businesses across multiple African markets have repeatedly found that internal theft, not market competition, not bad luck, not even poor business decisions, is one of the leading causes of business failure within the first 5 years. Not external threats, internal ones. The people inside the building. And here is the part that should genuinely concern you. The employees stealing from businesses are rarely the ones who look suspicious. They are rarely new, rarely disgruntled, rarely obviously dishonest. In the vast majority of cases documented by auditors and loss prevention specialists, the person responsible for the largest losses is the most trusted employee in the building, the one who has been there longest, the one the owner would have named last if asked to guess. Dangote understood this dynamic before his businesses reached industrial scale. And the systems he built to address it are not complicated, not expensive, and not based on suspicion or paranoia. They are based on something far more powerful, structural verification, that makes theft difficult, regardless of who is tempted to attempt it. Today I am going to show you exactly how to detect what may already be happening inside your business, and exactly how to build the systems that make it nearly impossible going forward. Why this is so hard to see. Let me explain why internal theft is so difficult to detect using normal observation alone. You see your business every day. You know your employees. You have built relationships with them, sometimes over years. This familiarity, which feels like an advantage, is actually the single biggest reason theft goes undetected for so long. When you trust someone, your brain stops verifying them. This is not a flaw in your character. It is how human cognition works. Once trust is established, the mental energy required to continuously verify someone's actions drops dramatically. You stop counting. You stop double-checking. You start assuming. The employee who has worked for you for 3 years without incident has built what behavioral economists call a trust account, and that trust account, once built up, becomes the very thing that allows small thefts to go unnoticed. Because questioning a trusted long-term employee feels almost insulting, almost paranoid, almost like a betrayal of the relationship you have built together. This is precisely why the most damaging internal theft in businesses worldwide is committed by long-tenured, trusted employees rather than new or suspicious-seeming ones. They have the access. They have the knowledge of how the systems work. And critically, they have the trust that prevents anyone from looking closely. Dangote runs an empire of over 30,000 employees. At that scale, personal trust cannot be the primary control mechanism. It is mathematically impossible to personally vouch for tens of thousands of people. So the systems that protect his businesses are not built on trusting fewer people. They are built on verifying everyone equally, regardless of tenure or relationship. This is the fundamental shift you need to make as a business owner in Africa today. Not from trust to suspicion, from trust as your only control mechanism to trust supported by verification. The 5 places theft hides in African businesses. Let me walk through exactly where theft typically occurs in small and medium businesses across this continent, based on patterns documented repeatedly across retail, trading, services, and manufacturing businesses of every size. The first place is the cash register or point of sale. This is the most obvious entry point and also the most commonly exploited. The methods vary, but the pattern is consistent. An employee rings up a sale for less than the actual price and pockets the difference. A trusted cashier voids transactions after the customer has already paid in cash. A till is short at the end of the day, and the explanation is always some version of, customers must have shortchanged me, or I think I miscounted. If your business handles any cash transactions, and you are not reconciling your till against your sales records every single day, not weekly, not monthly, every day, you have an open door that someone may already be walking through. The second place is inventory. This is the slowest and most invisible form of theft, which is precisely what makes it so dangerous. A small amount of stock disappears here and there. A few units, a small percentage. Nothing dramatic enough to trigger alarm on any single day. But compounded over months and years, inventory shrinkage can silently consume a business's entire profit margin. The methods include employees taking small amounts of product for personal use or resale, recording inventory counts inaccurately to cover for missing stock, or colluding with delivery personnel to under-record what actually arrives versus what was paid for. You have never conducted a full physical inventory count and compared it against your recorded inventory levels. You genuinely do not know whether this is happening in your business right now. The third place is supplier relationships. This is one of the most financially damaging forms of internal theft because it operates at a much larger scale than register theft or small inventory losses. An employee responsible for procurement accepts a payment from a supplier in exchange for awarding them a contract at an inflated price, with the difference split between the supplier and the employee. Or an employee creates a fake supplier entirely, a shell company that invoices the business for goods or services that were never delivered, with the payment funneled back to the employee. This type of theft is particularly dangerous because it often goes completely undetected by owners who do not personally review supplier relationships, contract terms, or delivery verification on a regular basis. The fourth place is payroll. This affects businesses with multiple employees and a degree of separation between the owner and the day-to-day administration of staff payments. Ghost employees, people who appear on the payroll but do not actually work for the business, with their salary collected by whoever controls the payroll system. Inflated hours or overtime claims that are approved without verification. Salary advances that are recorded as repaid when they were not. If you have not personally reviewed your complete payroll list against the people physically working in your business within the last 3 months, you cannot be certain this is not occurring. The fifth place is expense claims and petty cash. This is the smallest individual amount, but often the most frequent and the hardest to track because it involves dozens or hundreds of small transactions rather than a few large ones. Inflated receipts for legitimate business expenses. Personal purchases submitted as business expenses. Petty cash that is dispersed without a clear log of what it was used for and by whom. The behavioral signals that precede financial loss. Before we move into the systems that prevent theft, I want to address something important. There are behavioral patterns that frequently, though not always, precede or accompany internal theft. These are not proof of anything on their own. They are signals that warrant closer attention to your systems, not direct accusations against any individual. An employee who resists taking vacation or time off, particularly when they are the only person who fully understands a specific financial process, often does so because their absence would require someone else to review their work, and that review could reveal what they have been concealing. An employee who lives visibly beyond what their compensation would reasonably support, without a clear and verifiable explanation, is worth quiet attention, not confrontation, but increased verification of their specific area of responsibility. An employee who reacts with unusual defensiveness or hostility to standard audit procedures that apply equally to everyone is showing a response that deserves notice. Most honest employees feel neutral or mildly inconvenienced by routine checks. Strong resistance to a process that affects everyone equally is itself information. Discrepancies that are consistently explained away with the same type of excuse, always the same. Supplier having delivery issues, always the same till being slightly short. Always the same category of inventory, showing minor losses. You represent a pattern that random chance would not typically produce. I want to be very clear about something. None of these signals alone justify accusing anyone of anything. What they justify is increasing the rigor of your verification systems in that specific area. systems that apply to everyone, not just the person who triggered your attention. If you are still watching, subscribe right now, because what comes next is the actual system. The specific, practical structure that protects your business regardless of who you employ, how long you have known them, or how much you trust them personally. The verification system Dangote built at scale. Here is the principle underlying everything. Dangote built to protect his businesses from internal theft as they grew, from a single trading operation into an empire spanning multiple countries and tens of thousands of employees. No single person should have complete, unverified control over any financial process from beginning to end. This principle is called separation of duties in financial management, and it is the single most powerful tool available to any business owner. Regardless of size, regardless of budget, regardless of how sophisticated their accounting systems are. Let me show you exactly how to apply it at whatever scale your business currently operates. The first application is separating who handles money from who records money. If the same person who collects cash from customers is also the person who records that cash in your books, you have no real verification happening. They can simply adjust both numbers to match, regardless of what actually happened. The fix, even in a business with only 2 or 3 employees, is to ensure that whoever physically handles cash is not the same person who reconciles the cash records at the end of the day. If you only have 1 employee besides yourself, you become the second check. You personally reconcile the till against the sales record every single day, without exception, regardless of how much you trust the person handling it. The second application is separating who approves purchases from who receives goods. If the same person who decides what to buy and how much to pay is also the person who confirms that the goods arrived, they can approve a purchase from a fake or inflated supplier and simply confirm receipt of goods that were never delivered or were delivered at a lower quantity than recorded. The fix is to ensure that whoever approves a purchase order is not the same person who signs for delivery. Even in a small business, this can be as simple as the owner personally verifying any delivery above a certain value threshold, rather than delegating that verification entirely to the same employee who placed the order. The third application is mandatory unpredictable verification. Predictable checks are far less effective than unpredictable ones, because predictable checks can be prepared for. If your inventory count happens on the same day every month, anyone engaged in theft simply ensures everything looks correct on that specific day. Dangote's businesses conduct financial reviews daily, not because daily review of every detail is always necessary, but because the unpredictability of when deeper scrutiny will occur removes the ability to time deception around a known schedule. At your scale, this means conducting your till reconciliation, your inventory spot checks, and your expense reviews on a randomized basis rather than a fixed schedule. An employee who knows inventory is counted on the first of every month has 3 weeks to make adjustments. An employee who never knows when the next count will happen has no such window. The fourth application is the paper trail principle. Every transaction, regardless of size, should generate a record that exists independently of the person who created the transaction. This means receipts, invoices, and confirmations that involve at least one party outside the immediate transaction: a customer who receives a receipt, a supplier who issues an invoice, a bank that processes a payment. Cash transactions with no receipt, no invoice, and no independent record are the single most exploitable gap in any business's financial controls, because they leave no trail for anyone to verify against later. Wherever possible, move toward transactions that generate independent records, mobile money transfers instead of cash, formal invoices instead of verbal agreements, digital records instead of handwritten notes that can be altered after the fact. The fifth application is the owner's personal review. Regardless of how many employees you have or how sophisticated your systems become, there is no substitute for the business owner personally reviewing the actual numbers on a consistent basis, not delegating this entirely, not assuming that because you have hired someone trustworthy, Your personal attention is no longer required. Dangote reviews financial performance across his companies every single day, not because he distrusts his managers, because the simple act of knowing that the owner reviews the numbers personally and regularly has itself one of the most powerful deterrents against theft that exists. People are far less likely to attempt deception when they know someone is consistently looking closely at the results. What to do this week? I want to leave you with specific, immediate actions, rather than only principles. This week, conduct a surprise reconciliation of whatever process in your business involves the most cash or the most valuable inventory. Do not announce it in advance. Compare what should be there against what is actually there, and note any discrepancy, however small. This week, identify one process in your business where a single person currently has complete, unverified control from beginning to end. Whether that is cash handling, procurement, payroll, or inventory management, and introduce one additional verification step into that process, even if it is as simple as you personally checking it before it is finalized. This week, review your full list of employees and confirm that every single person receiving payment from your business is someone you have personally verified is actively working for you. These 3 actions cost nothing beyond your time, and they begin closing the gaps that theft typically exploits. The deeper truth about trust and verification, I want to close with something important, because I do not want this video to leave you suspicious of every person who works for you. That is not the goal. And it is not how Dangote built an empire that depends on tens of thousands of people showing up and doing honest work every single day. The goal is not to trust less. The goal is to build systems strong enough that trust becomes safe to extend generously, because the structure around it makes deception difficult, regardless of who attempts it. A business with strong verification systems can afford to trust its people deeply, precisely because that trust is supported by structure, rather than left entirely exposed to whoever might be tempted in a moment of weakness or opportunity. A business with no verification systems is not actually demonstrating trust when it allows unchecked control. It is demonstrating exposure, and eventually, statistically, across enough employees and enough time, that exposure gets discovered by exactly the wrong person at exactly the wrong moment. Build the systems first, then extend the trust freely, knowing that the structure beneath it will catch what individual character sometimes does not. That is how Dangote built an organization that employs tens of thousands of people across multiple countries without that scale becoming an uncontrollable liability. It is available to you at whatever scale your business currently operates. Start this week. If this video showed you something you needed to see, subscribe, because next week we go deeper into the verification system Dangote uses before trusting any new business partner with his capital. See you there.